Stock market continues its rally this morning as earnings season continues. Let's take a look. Over the last week, of course, markets did rally to new highs. We wrote about this in this past weekend's newsletter. That's the good news. Now, the not so good news here is that as the markets have rallied, now we're almost nearly a 6% rally from the recent lows. Despite that rally, the internals of the market continue to remain very weak. The number of stocks trading above their 50-day moving average remains weak. Volume continues to decline here in the markets as well. And importantly, as we take a look at our overbought and oversold indicators, even on a weekly basis, the overbought conditions of the markets are now back to previous highs. On a daily basis as well, markets are very extended. In fact, on an overbought condition, back to levels that have previously preceded at least short-term corrections and consolidations in the market. Let's take a look at some of the technical indicators itself. First of all, as we talked about here, the markets are at a new high, so this is actually a good sign here. Markets have continued the rally here, coming off support previously, getting back to those previous levels of resistance, continuing their push higher. A lot of this rally driven by the large capitalization stocks in the markets, Apple, Facebook, Microsoft, Google, etc. That's been lifting the markets here. In particular, Tesla has been a big driver of this rally here over the last few days. But again, our money flow indicator is now back to very overbought conditions where we've seen these before. At these levels, normally we see the market start to consolidate its rally and again set up for a correction. And when would that correction likely occur? Well, that would be in the first 2 weeks of December, most likely. The reason is that mutual funds are going to have to distribute their capital gains, interest income, and dividend income for the year. And with a lot of mutual funds holding very low levels of cash right now, that means they're going to have to sell stock in order to raise those capital gains distributions in their fund. So again, expect there to be at least a correction sometime between mid to late November and the first 2 weeks of December as we get into that distribution season for mutual funds. But outside of that, really not a tremendous amount of downside risk here. Earnings continue to be good. The big risk this week, of course, is going to be the Federal Reserve. On Tuesday and Wednesday, they are going to have their FOMC meeting where they will announce tapering their balance sheet. Now, the markets completely expect this to occur. So again, with the full market expectation at the behest of the Fed, this allows the Fed the flexibility to announce taper that will start in December, $15 billion a month. That's exactly what the markets expect. Don't expect anything surprising out of this meeting at all because, again, markets have already priced this in. And importantly, the market is now pricing in the Fed to start hiking rates in July of next year. In fact, in 2022, the market's pricing in 3 rate hikes. So again, monetary policy is about to start getting tighter at a time where you have higher rates of inflation, of course, impacting profit margins, and the employment cost index at a record high here. Also, that is one of the largest costs for employers. Payrolls and salaries and benefits, huge costs for employers. That's now surging here as wages rise, and of course, that's going to impact profit margins further as well. So 2022 is certainly setting up for a lot more volatility. This has been a great year so far in the markets, but getting into next year, likely to see a pickup in volatility and the risk of a correction rises markedly between valuations, higher costs and inflation, and tighter monetary policy. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.